Hi everyone. For those of you who do not know me, I'm Tim. I run this website called 𝗪𝘆𝘀. So have been doing it for about 10 years full time already. So I don't know if I look very old or I still look young. But yeah, so I started 𝗪𝘆𝘀 after uni. Went full time since 2015. All right. So just FYI, whatever I say today, obviously is my view, my opinion. I'm not here to give any investment advice. But I would just want to share my perspective and insights on what I observe about the market, right? So today's topic is about what you need to know about investing in your 20s. So if you are in your 20s, then great, you are in the right place. If you are older than in your 20s or you're not in your 20s anymore like me, it's fine. There will still be useful information that will help you, or you can also share it with people who are in their 20s, all right? So this is 𝗪𝘆𝘀, a little bit about us. We predominantly are a website that write articles, so you may have read our article, you may have seen it on Facebook. We are also on Telegram and Instagram, so feel free to follow us if you like to. All right. So besides inheriting money and winning the lottery, right, which is great ways to make money, by the way, there's two other ways to make money, right? So typically you work hard for money. This is what we've been taught since young. Right, so since young, we study hard, we get into a good school, we study harder, we get into a better school, then we hope we get a good internship, we graduate, we hope we get a good job, and then we continue to work even harder, right? So the whole education system teaches us how to work hard for money, but the other way to make money is to make money work hard for you, which is basically investing, right? Which is what I'm going to talk about today. Very often people focus on the first thing, they don't focus on the second thing. But the second thing is actually the other way to make money besides just working hard like me, right? I'm here today because I have to work hard, but we should think about the second thing, right? So there are reasons to start early. So it's just like when you work hard for money, you want to get a good job, you need a good education. You've been taught to study hard since young. When it comes to investing, it's the same thing. It is better to start earlier. Right, when I was younger, I used to think that investing is when you are older, you got money, then you start investing. Because I don't have money, how I invest, right? But the truth is that investing is more like a life skill. You need to start when you're young, so that as you grow older, you become a more proficient investing. And I will give you guys 3 reasons today why it's important to start early. And the first reason is really just compound interest, right? You guys may have seen a graph that looks somewhat similar to this. But I went through the stats, I will just churn out the numbers again. So this is actually just 2 persons, Alex and Ben, A and B, right? Alex invested $1,000 a month from the age of 25 to 35. $1,000 a month, so $12,000 a year, $120,000 over 10 years. And it's a hypothetical, so we just assume a 7% per annum interest rate compounded annually at the end of the year, right? So at the end of 10 years, Alex gets $165,000, right? So that's a pretty good return. He will be happy. But what happens? At the age of 35, Alex decided that he's not going to invest anymore, right? Because he has kids, he doesn't have enough money, he needs to stop investing. So he just puts his money in the same investments that he has been making, and he just lets it compound, right? Ben started a little bit later, right? So he started investing age 35, my age. He started investing about $1,000 a month. Right, and he's faithfully investing for the next 30 years, all the way from 35 to 65, in exactly the same asset class as Alex, 7% per annum, right? So so over a 30 years period, he invests $360,000, right? So that's 3 times more than Alex. The shocking thing, which surprised people, including myself, I had to work out the maths twice to make sure I didn't miscalculate, is that at the end of, by the time they had both turned 65, the person who invested less money, Alex, invested only $120,000, but invested 10 years earlier, actually has more money than the person who invested 3 times more, but started 10 years later, right? So this is just the power of compound interest. They invest in exactly the same thing, 7% per annum. That's decent, but that's not super high. But at the age of 65, which is where most of us will retire, the person who started investing early for 10 years and then stopped investing after that actually has more money, right? That is the power of compound interest. Compound interest work in your favor if you are young, right? If you are older already, the math doesn't work out anymore, right? So that's the first reason to start investing early. The second reason is very simple, endurance, right? So why do you need endurance in the financial market? Very simple. This is the STI. So I just choose something local, the Straits Times Index. This is the STI from 1998 to about 2020, I believe, when I got the stats, right? And so about a 22-year period, right? And if you look at it in a 6-year sector, right? 6 years, so about 5 to 6 years. So this is all the boxes are about 5 to 6 years. What you will see is this, right? During this period, the first quadrant, who will invest? Anyone will invest? This is hindsight, huh? This is hindsight. You guys won't invest, right? Because it started high, dot-com bubble goes down, go up, go down again, right? So you feel like you're just kind of breaking even. How about the second quadrant? Who will invest? On hindsight, I don't see any hands, but I think you guys want to put your hands up, right? Because it goes down, it goes up. So that is a good period to invest. How about the third and the fourth quadrant? Would you invest in the third quadrant? 6 years period? Not really. Fourth quadrant? Not really. Today, STI is about 3,001. So you still won't invest, right? So out of 5 time period of about 5 years each, you will only invest in one period if you look at it from a 5 years point of view, right? It is very, and you cannot possibly guess also anyway which period will do well, because now I'm reflecting on hindsight, but at that point in time, we won't know, right? But if you look at it from a long-term perspective, it is logical to invest because the markets are going up, and this is excluding dividends. STI dividends about 3 to 4%. If you put it back into the markets, it would have compounded, right? So what I'm saying is that if you look at it from a 5-6 year period, it's very difficult. But if you have a 20-year period, you got the endurance to ride out the volatility, it is a lot easier to see, right? Here's another example. S&P 500, US market, last 20 years, right? First quadrant, not good. Second quadrant, also not good. So that's 10 years gone already, just like this. 10 years of not good. Third quadrant, good. Fourth quadrant, great, right? Even within the quadrant, there are peaks and troughs, but we will just ignore that for the time being, right? So out of 4 time period of 5 years, 2 out of 4 you won't invest, 2 out of 4 you will invest. 50% is a coin toss. And chances are you invest based on when you start investing. So you're not even thinking about the market. You're just thinking, okay, I'm young now, I'm 22, I start investing, right? But if you look at it, without the rate charts, it is an obvious decision already, right? So that's the point, right? You need the endurance to ride out volatility. And when you are young, you have the endurance. If you are already in your 50s or your 60s, unfortunately, you don't have the endurance anymore, right? Because average lifespan 80. The third reason to start investing is basically, it's like a life skill, right? You will start early, you will make mistakes, right? So for those of you who, I guess most of you have tried cooking before, right? You try to cook a dish or something like that. I recently tried cooking carbonara, right? So I watched all this YouTube video, I tried to make carbonara. And for some reason, even if I follow the instruction on the YouTube channel, on the YouTube video, I cannot get it right on my first time. I will make mistakes, right? And it's the same thing with investing. When you start investing, you will make mistakes. The key thing is that you need to make mistakes you can recover from. You cannot make mistakes you can't recover from. So an unrecoverable mistake would be something like you put 50,000 into crypto last 2 years. Your savings for the last 10 years, you put it in. It was in a platform that you cannot get the money out. That's an unrecoverable mistake, right? It's a bit like swimming also, right? When we learn how to swim, we always learn at a 1 meter pool, even if we want to eventually become proficient, right? And the reason is very simple. You need to learn to make mistakes before you can learn to become a better investor, right? But if you start to learn swimming in the deep end and you almost drown, you will not dare to swim anymore for the next few years because of that fear, right? So you need to start early, you need to start small, and you need to be prepared to make mistakes. So these are the 3 reasons why you should start investing early. And now I will just talk about 3 investment principles you need to know if you want to start today, all right? So the first is risk versus return. The second is diversification. The third is dollar cost averaging, okay? It is simple. I'll explain it in a simple way, but they are vital if you want to be successful in the long term, okay? Risk versus return. A lot of people say high risk equals high return. That is true to some extent, right? You cannot possibly, if let's say you like Apple, right? Not just as a consumer, but as an investor. You invest in Apple bonds, means you lend money to Apple. How much will Apple give you? 3-4% per annum, right? Because you're not taking risks. We all know Apple most likely will return money back to us, right? But if you invest in Apple stock, you are taking more risks. Hence, your expected return would be higher, right? You would expect to make more than 3-4% per annum because you are taking more risks, right? So a lot of people think high risk, high return. So I see some young people, you probably think, hey, I can take high risk, so let me take high risk. Let me invest in a couple of small cap companies that I heard my friend tell me because they are risky, and should I get a higher return? The answer is no, right? High risk means high return, but not always, because you are not rewarded for taking risks that are unsystematic, right? So if you learn finance, you will know this. For those of you who are new to finance, there's two kinds of risks in the investment space. Systematic risk, unsystematic risk. You only get rewarded as an investor if you take systematic risk, not if you take unsystematic risk. So what's unsystematic risk? Very simple. Unsystematic risk is the risk you take that you could have diversified away from, right? So let me give you an example using DBS. DBS is the biggest, I'm not giving advice on DBS. I think all of us have money with DBS today, so we all must think that DBS is safe, right? So let me use DBS from a point of view as an investor, right? So if you invest in DBS, where will your returns come from, right? Your returns will come if the markets do well. Interest rate goes up, DBS margin is higher. Same for the other local banks as well, right? So you get the returns, right? Interest rate goes down, DBS and the other local bank margin goes down, so you make lesser returns or even sometimes losses, right? This is how your returns come from. But there is a diversifiable risk within DBS, right? Which is that somehow the bank management not good, there was an issue, payments, whatever, right? A fraud, anything that could be unique to DBS, right? That is the risk you want to get rid of, right? And so you still want to invest in the financial sector because you believe the markets will do well, but you need to take away the diversifiable risk. And that is simply, you take it away by investing in the market. You don't just invest in one stock, you invest in multiple stocks within the sector or across different sectors as well. And that is the risk that you will be rewarded for, not the risk of putting all your money into a single stock, even if it's the best stock in the world, thinking that it will give you the best return. That risk, you are not rewarded for that, all right? So you need to diversify your risk away, right? And what does it mean to diversify? We use this example very often, so I'll just say it. Imagine you go to a different country today and you want to try a good food in a very popular restaurant. But when you go there, you cannot read the menu. You don't understand the menu, right? So what do? Right? The not so smart thing to do will be to just choose something and hope that you choose something good. That is the not so smart thing to do, right? You may still get a good meal, don't get me wrong, but you may get a terrible meal that you cannot finish also, right? The smarter thing to do is to either join a group of local or you just take that chef special, the 𝗪𝘆𝘀𝗀, where you try a little bit of everything, right? And the thing is that when you try a little bit of everything, some things you may not like, a lot of the things you may like, overall you will get a good meal, you are happy, and when you are more proficient, next time you come back, you can invest/eat in what you like, right? Rather than to just choose one thing and hope for the best. Right? So, yeah, you know, and there's this thing called ETFs. I'm not talking about ETFs today, but there's this thing called ETFs where the ETF manager, there are some outside, they take the best companies or the biggest companies in the market, they put it into a fund, an exchange-traded fund. So if you're talking about the S&P 500 of the biggest company in the US, and that is your 𝗪𝘀𝘀𝗀 meal, right? Where you get to sample a little bit of everything. Some may not do well, others will do better. Overall, as long as the economy does well, you get a good return or a nice meal, all right? So that is the diversification. Remember, you must diversify in order to your unsystematic risk away, all right? Right strategy for the right race. Okay, this slide I put it in because a lot of people like to think they can take high risk, but they think they can take high risk only because they are only in the market for a short while, right? So if you need to go for a roller coaster ride for 5 minutes, this will give you the return you are seeking, right? exciting ride. But if I tell you that you need to be on a roller coaster for 2 hours, you will choose this immediately, right? Right? It's not so risky, but because you want to be in it for the long haul, you need to choose something which is, you can accept the risk over a longer period of time, right? And the last part, dollar cost averaging. Okay, this, I don't know whether you can see, this is my actual running timing in some of my runs, okay? So I still do my 2.4 kilometer like most guys in Singapore, young guys in Singapore, we do our 2.4 kilometer run, right? And every year during my 2.4 kilometer run nowadays, I'm 36 already, right? I still do my IPPT. Whenever I go there, I will look at other people, the other runners around me, right? And I will see a few things. I'll see some young, fit-looking guy, and I think they look like they can run very fast, right? And when the race starts, they run quite fast. And I know that I'm not in their weight class anymore. I'm not going to try to chase them, right? I will run at my own pace. I will also see some people that don't look like they can run very fast, but somehow they are running quite fast. And then I think to myself, oh no, you know, am I running too slow? Because he doesn't look like he trained and he's running faster than me. But because I run quite often since young, I'm quite a consistent runner. So I know my own pace. So you can see this is a random run I took recently, right? I run about 2.4 kilometer, and you can see my pace, right? It's almost the same throughout the run, right? I'm quite good in it, right? Not that it's fast, but I'm just good in running at the same pace for the race that I'm in, whether it's 42 kilometer or 2.4 kilometer, right? And in the 2.4 kilometer run, what happens is that by the 3rd round or the 4th round, I will overtake some of these people that start too fast, not because I'm running fast, but because they already walk. They drop out, right? They drop out. It's like your investment, they drop out. They just stop investing because they realize they started too fast. So in investing, it's the same concept, right? A lot of people look around them and they see what their friends are investing, how much their friends are investing, but they don't think about what is their stamina, right? What can I invest that can be consistent, right? And dollar cost averaging is very important in my view when it comes to investing because the markets are volatile, right? When the markets are volatile, you want to go at a consistent pace, right? So that when markets are cheaper, you invest, you get more investment units. When markets are more expensive, you invest, you get lesser investment units. Over the long term, you get an average price, just like my running, average time, right? And timing the market is very difficult. A lot of people think, okay, so I give you guys a simple hint. After the bear market, you all can invest, right? Because markets are down, you should invest. More or less, you will come out correct. But the problem is that it's very difficult to determine how long the bear market will be, right? So the most recent time, which a lot of people remember, COVID, right? When the markets and the S&P go down by 30%, most people were saying at that point in time, don't invest, right? Because the last time round, it took a few months, a couple of years before the market recovers. But what happened? The market recovers within 5 months, right? But you can see this also was an outlier. The recession before, the market took 17 months in the bear market, so this is 1.5 years, and then it took about 4 years to recover, right? So, and the recession before, this is the dot-com bubble, it went into a recession, bear market about 31 months, recovery about 56 months. So this is almost 5 years to recover, right? So the thing is that you cannot time the market because you cannot try to guess when the market will bottom up because you don't know, right? And I always tell people who try to guess the market is like trying to predict when COVID-19 will end. Do you all remember when COVID-19 started, there were a lot of experts saying that by the end of the year, right? Based on the past, by the end of the year, right? But now it's 2 years, 3 years. Now they're saying that you probably have to live with it, which I think so, right? So you cannot try to guess the future because the future is not set in stone, right? What you can do is you can look at history and ask yourself some questions, right? Okay, there's 2 charts here. Both charts are important. I know I got 20 seconds, but I will be done in 2 minutes, okay? Both charts are important. The first chart is showing the S&P 500. It is showing that even during good years, and there are quite a lot of them, the markets can go down a fair bit during the year, right? So for example, let's see this 30% here, right? 30% is a great year. Market went down about, at its most 6%, right? There are years where, you know, the markets can go down a fair bit as well, right? So even within a year, markets go up and down quite a fair bit. The second chart is simply saying that, think of a rainbow, right? Whenever there's bad times, heavy storm, there could be a rainbow at the end of the day, right? So after bear markets, very bad bear markets, the next 12 months, they tend to be better. They tend to be better, all right? But there is a problem here, and the problem is very simple. If you are the kind of person who tends to sell once you see that you are making losses, you might easily miss out some of the best days in the market, and immediately your returns drop. So this is, if you miss the 10 best days in the market, your returns drop from 45,000 to 20,000. Just 10 days only. 10 days makes all the returns in the market, actually. You miss those 10 days over a 30, 40-year period, your returns immediately half, right? So what happens to some investors is that they have a bad habit where the markets are bad, they tend to sell. And when they sell, they think to themselves, never mind, when it's going up again, I will invest. But the problem is that the good days in the markets always happen more or less during the recessions. And you don't know when the recessions or when that good day will be in that period of 2-3 years. It's just as simple as that. And that is the reason why it is important to stay invested, dollar cost average, okay? So this year, I'm just going to sum it up. Don't need to worry about what other people are doing. Just remember, you're running a race on your own. You're not trying to compete with the guy who's taking IPPT Go, right? Just run at your own pace. Don't worry too much about bull or bear market. Stay disciplined. This is the Warren Buffett advice, you know, when people are, be scared when people are greedy, when others are fearful. Go further, not faster. Just remember that. Go further, not faster. All right? When it comes to a race, go further, not faster. You must invest in a well-diversified portfolio. This advice only makes sense if your portfolio is well-diversified in the first place. And last one, DCA not an excuse to invest in everything. You have to DCA into good companies or diversified portfolios, not weak companies. All right? And with that, I'm done. So thank you so much for listening.